Hey everybody, Kyle, not your average finance guy here, coming back. I had a question the other day. A couple was talking to me, and they said that they understand all the velocity banking, they understand the math, but it's like they weren't sure how to get started. So after this brief conversation with them, this was in person, so I don't know any of their numbers, so I just I made them up here. But um, this video, it's kind of common that people they understand the theory behind it, but actually putting it into place or implementing it is I've heard that before. So kind of want to make a short video here of going through all that to kind of show how to get things rolling. So um, this I just I put together a calendar of potential expenses coming in throughout the month. Again, these numbers are completely made up. I have no idea what they're doing. I know that both of them work. I know the husband gets paid weekly, and the other one works in a school, so I'm assuming they get paid on the 1st and the 15th. I'm literally making assumptions here, but I do know that they have a HELOC. I don't know how much for, but it's at 8%, and they've got a camper loan that they're trying to get rid of. I assume that, again, I'm making these numbers up too, but I know it's at 6%. They thought they had about 7 more years left. So I'm assuming it's a $450 payment with a $27,000 balance. And they said that they would love to get rid of that, either selling it or getting rid of that payment one way or another. So just kind of want to go through a brief example of how to possibly do that. So with this calendar here, I just kind of wrote, in the green that we got a paycheck coming in of 2,000, and then this is on the first of the month, and then we've got 1,250 out for the mortgage, and then $450 coming out for this payment. Now this is just the regular way they used to do it out of their checking account, debit cards. I just threw in $500 of miscellaneous throughout the week. Maybe it's groceries, maybe it's whatever it is, going to a baseball game, whatever throughout the week is. I just threw $500 in every week. Maybe you got 100 comes out here, maybe you got 200 here and 200 for the weekend, or however you do it. So no rhyme or reason. I threw in $150 for your phone internet bill on the 5th, and then we got another paycheck coming in every Wednesday, and then we got the insurance bill. We'll say that's due. Homeowners and and the camper say everything's due there on the 7th, and then we get another $500 miscellaneous. Got another paycheck coming in. Say their electric bill is due on the 14th. I just threw $150 at that. We got another paycheck coming in on the 15th. And then I threw in here, we got our line of credit interest because they already had a $10,000 balance on their line of credit. So the $10,000 that equals about $67 on that payment. Again, another $500 miscellaneous. We got a paycheck coming in. The end of the month, there's really not much going out other than the miscellaneous. This is going to fluctuate, but just threw $500 at it. We got another paycheck coming in. So what it's going to kind of look like here. The way they started this, just their checking said they had initial balance of $1,500, and then on the first they got paid, right? So normally your $2,000 goes into your checking account, brings your balance up to $3,500. So their main question was, well, how do I get this started? Well, they've already got the HELOC in place with an initial balance of $10,000. I know there's a lot of numbers here. I'm sorry, but just bear with me. And then what they would normally do is the mortgage would then come out of their checking account of $1,250, leaving a balance of $2,250. And then here, what I would do is, let's say that they can't pay their mortgage from their HELOC, so just leave that in your checking account, okay? When that's paid, and remember, we're going to move this $27,000. We're going to move this over to our HELOC. Okay, so we're going to take the money from our line of credit, and we're gonna pay this off. So this payment essentially disappears. Okay, we just moved it over to our line of credit. We no longer have to pay the bank for this payment anymore. So that 7 years of making those payments is now gone because we moved it to our line of credit. All right, so we paid the mortgage, and from there, I in my checking account, I just leave 250. I leave $200 in mine. They want to, leave a little bit extra just in case. So okay, we'll leave 250 in there. So whatever you need to get to leaving 250 in there. So transfer 2,000 from your checking account over here to your line of credit. All right, so that takes your line of credit. Remember, we had a $10,000 beginning balance. We added $27,000 to pay off that loan, brings us up to 37, and then we deposited that $2,000. That brings our loan amount now down to 35,000. What we want to do is we want to knock this balance down as fast as we can, because this is what we're paying interest on, and it's daily. So every day that whatever this number is, you can knock that down faster. What the bank does is they take an average of that throughout the month, and that's what you pay your interest on. So the faster we can knock that down, the less interest we pay. The less interest we pay, obviously, the faster we knock down our debts. So we're back here. We transferred $2,000. This is here on the 1st. And then we got, looks like I forgot my $500 here. Did I forget my phone too? I sure did. Shit. No, look, we're Velocity Banking, right? So I didn't forget it. We got the $500 of miscellaneous is over here in the line of credit. So whatever you can get a debit card on your home equity line of credit. So where they used to use, throughout the week, they would use their debit card for this and that, whatever you need, groceries, whatever comes up. I got a sick daughter right now, so when you go to the doctor, you gotta get that debit card out. Whatever you do, instead of taking it out of the checking side, we just take it out of the HELOC side. Okay, all of our expenses come directly out of the line of credit because we just deposited our income into this side too. So this basically becomes our new checking account. So here the $500 gets added onto this balance. So 35,000 goes up to 35,500. And then the next one here, we've got the phones and internet bill. What I would do is I would try to pay all these with a credit card, and at the end of the month, make your credit card payment. That way you kind of push your expenses off, let the credit card hold on to those expenses. At the end of the month, you don't pay any interest on that. Pay your credit card off. But whatever, let's just say that you're going to use the debit card. Don't trust yourself with a credit card maybe. So let's just say we put that right against the line of credit. So here's our $150 for our phone internet bill. Comes over here, we're taking that out. Our balance goes to $650. Okay, here we've got $1,700 coming in. This is direct deposited. Still, it's going straight into our checking account. So just leave it there. Let it go in, and then that day, just deposit it back out. Okay, or I'm sorry, it deposits in, direct deposit, and then we're going to transfer it out, and we're going to move it over then to our line of credit. So this is going to pay our balance from $35,650 down to $33,950. Okay, so right here we got $350 insurance bill comes out on the 7th. So come down on the 7th and put that on your debit card again, going towards your HELOC, because remember, we put all of our income is going straight into our line of credit. We're only holding a $250 balance over here, so pay that directly from your line of credit. Brings that balance down to $34,300. And then from here, we're going to the 11th now is another $500 miscellaneous charge. So that's shown right here. So we're adding another $500 to the balance. We get a payment of $1,700 comes in on the 13th. So $1,700 in, we transfer it right out, bring it over here. So this balance is up, down, up, down. It's all over the place, but we want to drive this down as fast as we can over here, right? So for the 14th, we've got an electric bill due. So let's come down. Let's see. Looks like maybe I missed that one. I sure did. Okay, so this is off by $150. But so the 15th here, we've got the $2,000 comes in, and we've also got $67 of HELOC interest that's going to come out of the way my bank is. It pulls it directly out of my checking account. So we got that coming out. We got the $2,000 payment going in. And remember, this is where it gets a little screwy now. The numbers aren't so even anymore. We want to keep our balance at $250, so we're going to transfer the rest. So 1933 gets transferred over. So that comes over here to the 1933. Your balance goes down again to 31,000. And let's see, where are we? We are the 500 of miscellaneous comes out on the 18th right here. So balance again goes back up by the 500. we get a $1,700 paycheck. It goes into your checking account, and then you get online, make a transfer, and boom, send it. Send as much as you can, just keeping your balance. I keep mine at 200. They want to keep theirs at 250, whatever you feel comfortable with there. Send it right over to knock this balance down. Okay. And then at the end of the month, we got another $500 comes out, and we got another $1,700 coming in. Now, this one I did not move over directly because let's say the next month I just use, November and December here. The following month, let's say your mortgage payment automatically comes out of your checking account, and that's all, hooked up. And for a lot of times, sometimes they won't let you take that out of line of credit. I don't know why, or sometimes they do, sometimes they don't. So let's say we just leave our mortgage in taking out of the checking account. So that's why here at the 27th, I know I got my mortgage bill coming, here on the 1st. So I'm just going to let that $1,700 soak in there for a little bit. I'm not going to move it over right away. You totally could, especially if you only got your mortgage payment coming out. But let's say we just hold off till the 1st. Mortgage payment comes out, but we also get another paycheck. So that means we're just making a bigger transfer of $2,450 now over here on the 1st of the next month. So it doesn't have to be perfect. Obviously, right here on the 27th, you can do the math and figure out, how much. Actually, we didn't even have enough in it for the mortgage on this one, so we had to wait a little bit more until we got. I'm sorry, that is the mortgage. Yeah, we did have enough. So you could figure out right here if you wanted to hold out $1,250 for the mortgage and then send the balance. Would that be $450? You could send that over now, but I don't want to confuse people. It's not the end of the world if you let it soak in your checking account for a couple of days. You'll pay a couple more bucks in interest on the line of credit, but it's not the end of the world. So then this just kind of goes through the same scenario of what you did here. Now November I just threw 500. This is you're never going to nail it. Just try. Okay, give yourself a best good guess. When I went through here with the December payments, I said the miscellaneous. We're getting in close to Christmas, buying the kids some presents. I said that $500 went up to $1,500. If it does, you take your balance. Your balance goes up by that much. Again, get as much. Oh, and here I said that maybe you had a couple rain days. You didn't get a full week of work in. Maybe getting slow, so maybe the income's going down a little bit. So at this point, it's only $900 of income rather than the $1,700 we were used to when he was getting a good 40-hour week. So the $900 comes over here through the transfer, comes in over here, and then we got a $2,500 paycheck. So I'm saying the next week he got some overtime because they missed a couple rain days, so now they got to get it the next day. And let's say he got some overtime, that's a $2,500 paycheck. Again, send that right over here, and the balances are going to be up and down. But I guess the moral of this little example was they wanted to get rid of this payment. So the $450 payment, we pay that off with the line of credit. And as you can see, we started here with a high of $37,000. At the end, from 11/1 to 12/1, we're down to $28,000. So what's that? Almost nine. It's about $9,000 that we paid off, of this 27. So in theory, 3-4 months, your HELOC is now paid off, and now you're just back to the way you were going through running all your expenses through your checking account. At this point, if you want to take some of this line of credit money and invest it, get a life insurance policy, buy a new car, whatever you need to do, use this as your own banking system. So I hope this helps. Just I kind of wanted to get a short video of kind of how to implement this. Please, if you ever have any videos, other people are probably wondering the same thing. Be happy to make a short video, throw it out there. Hopefully together we can help a bunch of people. All right. Thanks. Good luck.